Hello everyone, welcome to another podcast that we do with RIAs. Today we have another esteemed guest, Mr. Amey Kulkarni, who has been doing the RIA practice for almost a decade, and we are going to see through the entire journey of why he started, as well as most importantly we are going to focus on some of the questions all of us have as an investors along with him. So welcome Amey, thanks for doing this.
Thanks Nikhil.
So I think we'd love to understand why you started Candor, and I think most importantly we loved the name. So why this name for the investment journey?
So it's a long story. I'll try to tell you in brief.
Sure.
So I was always interested in investing. So I have done my engineering, then worked for 2 years at Siemens Limited, and then did my MBA in finance. Right. So even before my MBA, I somehow chanced upon this book by Benjamin Graham, Intelligent Investor. So as luck would have it, that was the first investing book that I ever read, but that was the correct book that I read, right? Instead of reading some other random books.
Yeah.
And for 10 years almost, I have worked in corporates, L&T,
Yes.
Siemens, Jindal Steel and Power, and it never occurred to me that I can be in this business. But I was 32 and I attended one weekend course, right?
Okay.
By my ex-professor in MDI Gurgaon, Mr. Professor Sanjay Bakshi. And there I met almost 100 other people like me. And many of them told me that I am a private investor. I said, what is a private investor? So what they did, so they told me that I only manage my own money and maybe I help out some other investors as well, maybe friends, family, or also others.
Yeah.
And then it occurred to me that this can be an alternative career. Okay. So I had almost spent 9.5 years in corporates. It was never related to investing. But then at 32, I switched. I was last employed with L&T Realty.
Okay.
So that was February 17.
Oh.
And then I took the investment advisor license from SEBI in May 2018.
Okay.
Right. The name Candor also came because I was always, my expertise is in stocks, right? So advising on stocks. So I read this book in 2017-18 called Investing Between the Lines.
Okay.
Now in investing, when we invest in stocks, some stocks do well, some stocks don't do well, right? The really stocks where we end up losing money are the fraud stocks, right? Where the management was a problem, accounting was a problem, some other major issue was there. Business failure, we kind of realize, right? If we realize that the business is not very good, we end up selling it.
Yes.
But the real problem is when the company turns out to be fraud. And the premise of this book was, you can know if the company is fraud and sell in time if you just carefully read the annual reports. And one of the major, so the book charts out multiple criteria and all that, and one of the criteria is how open and transparent the management is when writing in the management discussion analysis or the shareholder letter about their business to the shareholders, right? So that is where the candor, candor means transparency and openness.
Yes.
The willingness to discuss even good parts and the bad parts about your business with your own owners. The shareholders are owners of the company, right? Absolutely. So the candor of the management is very important when it comes to detecting fraud. That is how the name of my company also started.
No, it's fabulous to know because it clearly highlights what you are building here, which is transparent. So, and everybody should be aware of the things. So you also make sure that your investors are aware.
See, investing is risky, okay? Out of all the asset classes, there are 4 asset classes, right? Just to revise: gold, real estate, FD, and equity. The other 3 asset classes, in most cases, we don't end up losing money. Right?
Yeah.
In equity, there is a good chance that we will end up losing money.
Yes.
So we have to tell the investor, make them aware of the bad parts, so that they have the capacity to digest it and then also reap the benefits.
Yes.
Right? So if you can, अगर विष पी सकते हो तो अमृत भी मिलेगा.
Definitely. No, fabulous. I think now in this journey as an investor, as you rightly said, all of us investors are doing our own jobs. I am being one of the investors or one of the things, because we are not aware of so many risks because we are doing something else in our lives. So it is so difficult for us, I think. But all of us, I think, in the era that today, as you rightly switched your career at the age of 32, from anybody who is 30 or anybody till 50, one point or one question that all of us have about money especially, and that looks like a holy grail of investing, which is, when do I retire and how do I retire? So what would you suggest?
So let me come to the arithmetic part. That is what I think. You know, given assuming you have a small family, maybe 2 kids or parents or whatever, right? Living in a metro, like top 10 cities, wanting to have your own house, and normal middle class, upper middle class lifestyle.
Absolutely.
I think the number that you need is $1 million.
Oh,
So today $1 million is about 8.5 crores. 8.5 crores is something liquid investments apart from your primary home is what you need to retire. However, I would try to go one step further. What will you do after retirement? Because it's a life of absolute boredom.
yeah, I think that is also true.
So you have to be very careful of aspiring. See, especially life is like that. Whatever you aspire for, you end up getting it. The problem is only timing.
Yes.
You may want it in 2 years, you will get it in 20 years. But if you aspire for a retired life, you have to be very clear what you will do after that.
Yeah.
So
But be careful what you wish for.
Be careful what you wish for. You most of the times you end up getting it. Okay?
Perfect. Yeah.
But so in terms of number, I think the thumb rule is $1 million.
Okay.
You can lead a comfortable life in a metro in India with $1 million.
So $1 million is a fabulous number, staggering to be very honest. The most important question then I will have is, are you financially independent?
See, I was financially independent before this market crash. Okay, so 1 year back I had reached that magic figure of $1 million. But then life happened, 2 things happened. Okay,
Yeah.
I bought my second house.
Okay.
So 30% of my net worth went into the second house, and I'm staying in that house. So I have to deduct that from my investable surplus. And the market, I didn't end up selling some of the shares. So my portfolio is down by 30%.
Oh.
So my answer to your question is yes and no. I was financially independent, today I am not.
Okay. No, but still that is a very aspirational thing. That means financial independence is something that someone can achieve. Very sure that with the help of someone like you who has done it previously, who has a methodical way of doing it, and maybe looks like that investing in the right asset classes where you choose the right stocks is possible. So I would like to understand then that what is this investing all about? What do you mean by investing and what can it achieve me?
So let me tackle at the broad level. I think this is very important because I see this amongst many people. In most cases, higher and higher expertise or complication results in better results or better pay or higher salary, right? But in investing, more the complicated thing, it doesn't work.
Oh.
Okay? The fundamentals work, simplicity works. The problem in investing is there is so much information and so much availability that the mind gets confused and forgets the fundamentals. I'll give you a recent example. Gensol has been a fraud, right? If you have been an equity investor, you have lost a lot of money. But do you also know that people have invested in the debt of Blue Smart?
Oh. Okay.
Right? Blue Smart is a sister company of Gensol. It's a cab hailing company.
Yes.
People have actually subscribed to bonds of Blue Smart through various online bond selling platforms. Right? There are many. We can name, I think, 3, 4, 5, 10, which are big startups and they are doing well, right? So there are a lot of fintech startups which are selling bonds, risky bonds. Now, what you have to understand, when you are giving a loan to somebody, the maximum you get is the interest. So upside is not yours. If the company becomes successful, then the upside is the company which has borrowed money from you. As a lender, it's not your upside. The maximum you will get is 10, 11, 12, 13, 15%, right? However, if the company does not do well, you will lose your entire principal. So what is the innovation that has happened? So the banks are not selling these bonds of loss-making startup companies, right? Which ride-hailing company in India has been profitable for the last 15 years? Ola is not profitable, Uber is not profitable, of course Blue Smart will not be profitable, right? I don't think Rapido is also profitable. Why are you lending to a loss-making company? If you want to take risk, please buy Gensol shares, please buy Blue Smart shares. At least you have signed up for losing your money. But when you're lending to these businesses, you have not signed up for losing that money.
Definitely.
Right?
Yeah.
So keep it simple. So to come back to your question, right? What works in investing, right? the thing that works in investing is simplistic fundamentals. Go back to the fundamentals and reduce your risk. Be disciplined. So two things work: discipline and consistency works.
Absolutely.
So if you are disciplined in your savings and investing pattern, and you do it over a long period of time, then compound interest will make sure that you end up with a large amount of some 10, 15, 20, 25 years down the line, right?
Yeah.
The rate of return has to be respectable. When I mean respectable, it should be higher than inflation.
Yeah.
Typically, even if you make 10 to 12% returns, which is generally not considered high by most of us, but if you do it for 20 years, you will end up with a big number, right? Now, maybe many of the investors will have this question, right? What is a reasonable rate of return that I can expect from stocks?
Yes.
So I have a very simple way of thumb rule of saying this, right? Our GDP grows by say 6% every year, right? And our inflation is approximately 6% every year. So if you take the last 35-year average since 91, right, after reforms. So if you take the average, the GDP has grown by 6%, the inflation has been at least 6%.
Yeah.
So GDP plus inflation is a reasonable expectation that you can have from your mutual fund portfolio. So between 10 to 12%.
Yeah.
So if for the next 10 years GDP grows by 10% and inflation is 5%, maybe you will make 15.
Absolutely.
If the GDP grows by 5 and the inflation is only 3, maybe we will make 8% returns. Right?
Yeah.
In stocks, you can expect, if you do a good job, you can expect to make 3, 4, 5% more. So 12 plus 3, 15 is not a bad expectation.
Yeah.
However, it's non-linear.
Yes.
Not every year will be a profit. So you have to have, after 5 years, 7 years, 10 years, you can expect this kind of returns, hopefully higher.
No, absolutely. As you rightly said, I think one major point that as an investor I have to take is that nothing is absolute. Everything has to be taken over the longer duration of the time, right? Because we have to see the cycles. The cycles keep moving forward, backward, sometimes up and down. And each of us as an investor, we keep hearing this long term. Why long term? Because I genuinely want a tablet right now. Who can cure me? Who can make me financially independent? Why should I worry about long term and what actually it means to be a long term? And if you can illustrate us saying that how long term actually creates this massive impact on my wealth.
See, why every advisor, every mutual fund person or any financial advisor will keep telling you long term, right?
Yeah.
See, markets will move unexpectedly. Some war will happen, some other problem will happen, some election will happen. All kinds of random things will keep happening in the world, right? So the markets will be random in the next 1 to 3 years. The reason we always tell investors to have a long time horizon is because markets are going to fall at unexpected times. Yes. You don't want to be forced to sell your investments at the wrong time. So if you're going to put money in equities, then over two things, only put that money which you don't need in the next 1 to 3 years. And be willing to wait for 5, 7, 10, 15 years. The reason is the market, as I told you, you should not be. So for example, let's take an example. You invested in 2018, for example, right? And then 2020 happened. And then you have to, you have to pay off some loan or whatever XYZ happens. And then you have to forcibly sell your equity investments in March 2020. What will happen? If you versus you did nothing, you knew nothing about stocks, nothing about mutual funds, you had absolutely no idea, but you just waited for 2 years, and you sold your investments in March 2022. The difference was almost, I think, 3x. Right, from the bottom to say March 22.
It was, yes.
Right. So that is why we say long term, right? And it's a simple arithmetic of compound interest. I think everybody should actually do this calculation by their own hands in an Excel sheet. If you don't know how to do an Excel sheet, please learn. Because some things in life you have to do it yourselves to understand the power. Yes. Just compound your money at 10% for the next 20 years and do it at 15%, do it at 20%. And just see how much that 1 rupee becomes. Right? When you do it yourself, you'll realize how compound interest works.
Yeah. No, definitely. I think now it is clearer to my head also that why we should let the compounding do its magic, basically what we all tell. And as you rightly said, the typical equity market or the markets in general go with ups and downs. And we have seen that especially in the stock market, we have seen those returns going ups and downs, but at the same time giving 3x, 4x kind of returns also to the investors, which ultimately have turned their lives around, because somebody would have made actually life-changing money in that, so that they can actually go back to that dream of financial retirement. You especially have been a stock expert, so fundamental question then arises, in among these all asset classes, why you are focused on stocks, and why some of us, at least who have the some amount to be invested into stocks, why we should focus on the stocks?
See, the answer is very simple. The upside is very high, right? If the business does well. So I'll give you, this example I give to everybody. But if you invest 100 rupees in stocks, right? The maximum that you can lose is 100. However, if the company does well, then 100 can become 10,000, it can even become 10 lakhs. And there have been actual examples, several examples just in India, right? Just imagine if you had bought HDFC Bank in 95, right? Kotak Bank in 2007 or 8 or whenever it was listed, right?
Yes.
TCS when it was listed in 2004,
Yes.
right? Forget those big companies, even small companies, like maybe people have heard of a company called Manappuram Finance, right? It is into gold lending. If you had invested any time in the last, say, 20 years. So the company went for an IPO in 94.
Okay.
But even if you had invested in 2007, 8, 9, 10, you still have made 20x, 50x, probably 500x, 1000x. Since 94, I think the company is around 1000x.
Wow.
Right? So the upside is, possibility is there. There is no surety, there is no guarantee. But this is a field where that upside is tremendous.
Tremendous, absolutely.
So after you are done with your basic needs, right? Basic expenses, emergency funds, basic funds where you think this is the security that I need. What if I lose my job? What if I am not able to find a new job for the next 4 months? After that, your money can go to avenues where the upside is high. Second, the most important thing is, see, stocks have a logic. Okay? The logic is this: if the business grows, if the business starts selling to new customers, new geographies, comes out with a new product which is better than its competition, right? If its revenue increases, if its profit increases, then the business has done better. If the business over several years has done better, automatically the stock price will follow. So the logic is that if the business does well, stock price will increase.
Definitely.
So if you focus, so there is a predictability per se. I don't know where the stock price will be 6 months down the line, but if the business starts selling to 10 times more customers, starts selling at 200 rupees instead of 100 rupees for each product that it is selling, right? If its profit margin increases from 10 to 15% over the next 7-8 years, then automatically the profit is going to increase, the company is going to be worth more, the stock price is obviously going to increase. So there is a certain pattern, there is a certain predictability, and there is a certain study that can go into selecting these stocks. Vis-a-vis what I am saying is, say, Bitcoin, right? Bitcoin is very popular. I think Bitcoin has become gold, right? It has become like gold. However, there is no cash flow attached to it. So there is, in my opinion, to my mind, there is no predictability of where the price will go. Maybe it will go up, right? So it can form a certain portion of my wealth.
Absolutely.
But I don't think it can, gold or Bitcoin can form more than 5 to 10% of your entire wealth. Right? Because there is no predictability.
Yeah, definitely. So you are more or less saying that if you understand the logic behind why that price is moving, then don't focus on the price, but more focus on those attributes which can move that price around. And that's what I think with gold or with Bitcoin that happens, that it is more of a speculation rather than the intrinsic value of that asset class which is moving or which is indicative towards going to that uprise or fall or whatever it is. Because as you rightly said, I as an investor want some kind of predictability where my money will grow, when it will grow, how much it will grow. It can be less or more, but at least that predictability gives me the confidence that whether this is a good asset class or not.
Correct. Exactly.
Absolutely. Now, at the same time, although you are very much into the stocks, we have also seen that you also suggest mutual funds. So why that change for some customers maybe?
Yeah. No, I recommend investing in mutual funds for everybody. The reason is this, right? Mutual funds are very good diversified products, right? When I say equity, you can lose money, you can make money, right? But mutual funds typically invest in 50, 80, 90, 100 stocks, right? I'm also suggesting, say, index funds or diversified large cap funds, right? So what ends up happening is you will beat inflation through mutual funds, excellent product, the fees will be less, right? Typically, if you go direct, then or index funds, the fees are 0.5% or even less, right? Plus, you make sure that you get market returns. If the market has gone up by 12%, then more or less your mutual funds will also do 12%, right? So mutual funds have to form the basis of your personal fund, the foundation of your personal finance
portfolio
journey or portfolio, whatever you call it, right? Because they are low risk relatively. They have market risk, but relatively they have low risk, well diversified, low fees, right? You'll get market returns, and volatility is relatively less. So unless you have incidents like 2000 or 2009 or 2020 or before that 1974 or whichever, these incidents are also 15-20 years apart, right?
Absolutely.
Your portfolio will not go down by more than 20%
Yes.
or 15%, right? So which is fine. You can stomach that volatility, do SIPs, build up over a period of time.
Absolutely.
Stocks can be ulta.
Tumble
For
down.
no reason, good, great stocks will fall down by 50%. For 5 years, stock price will not move anywhere, right? Market has gone up by 50%, your stock is still there.
Absolutely.
I'll give you examples like, look at example like Tata Elxsi, right? Very good company. It is actually 100 bagger, more than 100 bagger in the last 15 years, right? Or last 12 years. If you look at that stock price in 2012, 2025, the stock has gone up more than 100%. But for the last 3 years, actually, I think the stock has fallen by 40%.
Oh, yeah.
So if you're invested in 2022, I think you have lost 30-40% of your money. I may be wrong on the exact numbers, but you'll get the trend.
Absolutely.
But if I invested in 2012,
you would have
you have made more than 100x.
Yeah.
Right? So that is the kind of volatility which is inherent in direct stocks.
Direct equity. Yeah, absolutely.
However, mutual funds remove that problem. They diversify across many. So it also gives you the confidence to invest in equity. See, for most people, equities looks risky, right? And there is a learning curve. Now we have like more than 16-17 crore demat accounts, right? Just 4 or 5 years back, most of the people had never experienced equity, right?
Oh, yeah.
So I think the number was less than 2.5 crores in March 2020.
Yeah.
Today I think the number is around 18 crores, right?
Absolutely.
So 75 to 80% of the investors have actually come after 2020 who have not experienced volatility so much.
Yeah, absolutely.
So when you look at your investing journey, if you start with mutual funds, you build the savings habit, you build the habit of consistency and discipline, you understand how equity works, and then you can go to stocks because by that time you have figured out whom to take advice from, what really works, what kind of stocks should I invest, should I do it myself, should I outsource it to somebody, whose help should I take, or whatever it is, right? Or at least your learning has happened over a period of time.
Yeah. I think with that learning, I'm very sure the information would have translated into knowledge also. Correct. Because as we were starting and you also said that there is a wide variety of information available, especially around stocks, and we have seen what is happening with Gensol, because many of us are very amateurs into the subject. We would not have find time to research that much, go into the depth of it. So our understanding will be at a very high level, not to the depth. And so that's why I think it is necessary for us to start with a less riskier, which is mutual funds, maybe build our knowledge base over the years, take some of the hits, see how the market turns out, and then maybe get our hands dirty with the real equity.
So Nikhil, here I will point two things, okay? There is no reward for heroism in investing, okay?
Yeah.
Secondly, there is nothing new to be discovered in investing. All the great people have already figured it out.
Okay.
It's a question of I as an investor reading it up and figuring it out. And every era has different names of stocks, right? The name of the stock will change depending on the time and the country. But what works in investing, how to make money has everything been figured out. There is no new innovation that will come or is coming.
Definitely.
Right? So please study the past. It's far better to give some fee to your advisor who has 20 years of experience investing in stocks and does that full time and of course has the right investing mindset and everything than trying to figure out yourself.
Absolutely.
Right?
Yeah.
You are far better off trying to get your next promotion in your job faster.
I was going to come to that only. I think it makes so much logical sense to provide this hand to the expert, because in this, as you rightly said, someone has already discovered, someone has implemented, someone is doing that for 24/7. How on earth I, as an investor who is just watching some YouTube videos or maybe reading some material, am I going to beat it? And I think that is where a person like you comes in, who is again unbiased, at the same time who is doing this as a full day job, so knows how to do this, is responsible enough, and as you rightly said, the mindset matches, I think, definitely.
So I think, Nikhil, that brings to one more critical question which I think we should also discuss.
Yeah.
Right? I think, that's my opinion, it's a very difficult task to choose the right advisor.
Absolutely.
So there is a lot of fraud in our industry. In fact, if you actually see, many people are not even registered with the correct forum, right? Like, we need to be registered with SEBI to advise, and there are a lot of rules that we need to follow, right? I think 98% of people who are charging money to give advice are not registered, number one. So, in my opinion, registration is an overhyped thing, but if you want to do it as a business, I think you should do it in the correct way.
Correct way.
Right? Number one. See, number two, forget the registration part, but it's actually difficult for me as a normal investor to figure out who will be a good advisor. See, because in investing, nothing happens in a day. Your good or bad decision you will actually come to know in the third, fourth, fifth year when you make money or lose money.
Absolutely.
Right? So the feedback loop is very long.
Yeah.
Like, if I buy a stock, it may go up by 50% in the next 6 months, but after 3 years it will be down by 80%, right?
Yes.
So I will actually realize, oh, I made a mistake 4 years back by buying this stock after 4 years.
Yes.
Right? So similar, so I'll give you some pointers what probably you need to do.
Yeah, definitely.
So number one is, I think your investors should not, your advisor should not be greedy, in the sense that he should charge you fees which should not be very high. And of course, good people will not charge you very low fees. So your fees that they charge should be in line with industry practice.
Yeah.
Okay.
Definitely.
The second thing is, the most important thing is the advisors, what the advisor tells you over a period of time. Right? So underperformance is going to happen for everybody. Stocks are going to go up, they are going to go down. So at any point of time, your portfolio is going to go down in spite of great advice.
Yeah.
Right? So when your portfolio goes down, what does your advisor say? Does he say the same thing what he was telling you when your portfolio was up? Or does he start giving you different reasons? Or start, his basically whatever he's saying starts changing.
Yeah.
So an advisor who gives you the same advice when your stock markets are high and when the stock markets are low, he is the guy who is more consistent and likely to benefit you more.
Absolutely.
That is how you choose the advisor.
Perfect. So as Amey, you said rightly that I should choose my advisor very, very aptly, I think, which should be something that I should focus as an investor more, because that alignment should be there. And as you rightly said, the markets will go up, will go down. But as an investor, I always think, or each of us thinks that, what should I do, especially when my stocks are down, when the market is down, what should be my action plan? So what would you advise on that?
See, I'll give you this arithmetic, right? So we discussed this some time back, that the GDP is growing by 6%, inflation is 6%, right? So if you actually see in nominal terms, the GDP is increasing by 12% every year. If you say 6 years, the GDP is actually doubling. That's the normal rate in India, and that is going to remain for a long time, right? More or less.
Yeah.
So stocks eventually are going to go up. It's only a short-term thing that those markets are down or some stocks are down. So if your portfolio is down, the first thing you have to do is figure out whether you are in the correct stock or a bad stock. If you have invested in a bad company, right, then you have to sell. The stock does not know whether you own it or don't. Second, you don't have to make back your money in the same stock. You will always lose some money in some stocks, you will make some money in the other stocks, right?
Yeah.
So you should reevaluate each and every stock independently whether you still want to keep holding it or not. Irrespective of the profit or loss, if you are not confident about the future of that stock, please sell.
Okay.
However, if you are confident about the future of that stock, right, but because of whatever temporary problems either inside the company or outside, like in the markets or macroeconomics or whatever it is, right, if the stock price is down, then buy more. Typically what has worked in investing is buying more when the markets are down. So when the markets are down, you actually buy more, right? Now the question is, you will ask me, Nikhil, मेरा पैसा तो खत्म हो गया. So that is where you have to work on your asset allocation.
Absolutely.
Right? Don't be too aggressive on any part.
Yeah.
Right? As a normal investor, there are risks and unknowns which are going to hit you exactly at the wrong time. Maybe March 20, I'll give you an example, right? What happened? So I have both business clients and I have salaried people.
Yeah.
March 20, business people just did not have the capacity to invest more, even if they realized, business people have a higher risk taking capacity than salaried people, right? So they realized that the market is down, I need to invest. However, their businesses are also shut. They were not earning anything, right? Small businesses, right? Absolutely. They're just not earning anything. So they did not have a visibility of when their earnings will start. They could not invest.
Yeah.
Right? So you have to have an asset allocation which is relatively conservative, and you need to have some portion in debt so that at market extremes you are able to take out money from debt and put in equities. See, markets are going to go to euphoric levels, they are going to go to desperate levels or fear levels or whatever we call it, right?
Absolutely.
That is going to happen whatever we do. Reasons will always be different, but this will keep following. So when the market is at euphoria level, please be a little
aware or
careful,
yeah.
right? So that when the market later goes to lower levels, you have money to invest.
Yeah. No, makes lot of sense, because as you rightly said, the asset allocation now becomes the center point of all of these things, because if I don't have the money to take the advantage of the situation, I think the train is gone.
Correct.
So in that, what do you typically advise on the lines of asset allocation for someone? How do you adjust that from someone's risk appetite as well as someone's life stage also, maybe? So yeah.
No, I have a slightly different take on this. Okay. So the typical way of doing it is, if you are older, then you have to be a more conservative asset allocation. If you are younger, you can be more aggressive and blah blah blah, right? Risk taking capacity and all that. Yeah. But I have a different view.
Okay.
So first is your house. If you want to buy a house, you buy a house, you stay in that house. So you have to concentrate your financial resources there. Then your emergency fund, then maybe for the next 1 year or 2 years expenses, and then one safety net, right, where you want to feel, okay, I have some money. Like if you have, this number could be different for everybody, but if I have 50 lakhs lying in the FD in the bank account, I feel, okay, I have good money, right? I have enough money. Or that number could be, say, 2 crores for somebody. Now, after that, so after that 50 lakhs or 2 crores that I have just lying in a plain simple fixed deposit, which I can break and use it anytime, everything else can be risk money. Right? Yeah. So if you have, say, 2 crores, out of that 50 lakhs is your safety net, 1.5 crores can go fully in equity. If you have 50 crores, if 50 lakhs is your safety net, then 49.5 crores can go into equities. Right? Now the next question is, do I want that entire 49.5 crores in equities or not, given the current market conditions or the stock ideas that I have or whatever XYZ, right? There you can play around. There you can say, I have a view that I want to be a little more conservative. Okay. So out of that surplus, which theoretically can go 100% in equity, I'll put 70% in equity, 30% waiting for a market crash so that I can deploy. See, I think one more thing I need to also explain, right? See, markets are a bull and a bear cycle.
Yes.
Right? One good bull cycle, if you participate well, your orbit will change. You will actually become financially independent. Yeah. If you are, लाखों में खेल रहे थे तो अभी करोड़ों में खेलोगे.
Yes.
और करोड़ों में खेल रहे थे तो $1 million में खेलना चालू करोगे. Right? Yeah. This will actually happen. This has happened with me and it has happened with countless others.
Yeah.
Who have done well.
Yeah, absolutely.
Right? So you have, so the purpose of asset allocation is to prepare you for that, to participate well in the next bull run.
Perfect. Yeah.
Right? So wait for that desperate market fall. Maybe it will happen in the next 6 months. Maybe it will happen after 6 years.
Yeah.
Be invested. I'm not saying fully withdraw. Yeah. Right? But you have you prepare increase your knowledge, increase your whatever conviction, understand equity, choose your advisor, figure out your savings, all that pattern, and then that one bull cycle that comes, you have to participate well.
So you have to be ready, basically.
You have to be ready
Absolutely.
for the next bull cycle.
Bull cycle.
Next bull cycle is going to come.
Yes.
If you are 20 or you are 60, doesn't matter. Your next bull cycle is going to come. It's going to come sometime in the next 10 years.
Yes.
Hopefully before much
that,
earlier.
Definitely,
right? So you have to be ready with that.
Yeah. No, fantastic. I think kind of reassuring in the current scenario, especially because I think all of us are kind of feeling the brunt of the current bear market, and we are seeing अरे कुछ होगा ही नहीं, but looks like नहीं यार ऐसा होता रहता है. Somebody like you who has seen so many cycles is someone who can assure us to be prepared. But I think one question as an investor always keeps in my head is that what are the good returns? Should I aim for 20% or should I look for that 100%? And as you rightly said, in some bull markets I might get 100%, but many a times while chasing that 100%, am I going to lose my sleep? Because the ups and downs will be there. So what should I focus on as an investor?
So I'll slightly change the this question that you asked, right? So I always say 20% returns is better than 100% returns.
Oh, okay.
The reason is this: if I'm able to put say 1 crore rupees and I make 20% returns, I get 20 lakh rupees, right? But if I go for a risky bet where I'm not very confident and I don't end up putting more than 1 lakh rupees, even if I make 100% in that return, the absolute number that I make is only 1 lakh, right? So assuming I have 1 crore, I want to look at places where the probability of success is high. Also, once the success comes, the returns have to be good, right? So when I'm saying 6% GDP growth, 6% inflation, so 6 plus 6 is 12, anywhere between 15 to 20% returns is very good.
Definitely.
Right?
So
you can try to aim higher, find the next multi-bagger and try to make 10x whatever XYZ, right? But those 10x, 20x stocks are extremely rare, and it's very rare that you will actually be able to find them and invest at the right time.
Yeah.
If you wait for long enough and search well, you will end up making those 10x returns, right? But we have to also be cognizant that they are rare.
Absolutely.
So we want to go to place, we want to take bets where we are certain that a decent return will come.
So basically, as an investor, I should also make sure that do I have the clarity and the confidence before making that bet, because otherwise I'm definitely going to lose my sleep.
Because the downside is also there, the risk is also there of losing money.
Yeah, absolutely. Now, I think we talked a lot about investing, right? But ultimately, all of us are trying to invest or become financially independent because we all have some goals in life. I want to do something, I want to be financially independent, I want to travel the world or something like that. But I think as Indians, the biggest goal that we have seen is I want to buy a house. And in the last 2-3 years, we have especially seen internet especially speaking completely two views on that. And so definitely as a financial advisor who has seen this journey for so long and who has worked with so many clients, what is your view? Should I not think about buying anything, or should I actually only buy and rent? What are your views on this topic?
So I have some strong views on this, and however the answer depends on the person's background and life stage. So let me explain. So for 90% of Indians, their parents never owned a proper house, right?
Yeah.
So for 90% of Indians, even today, owning a good house is one of their biggest dreams. So as soon as they can afford a house, they should go and buy a house. Take maximum loan, right? The next question is how much loan should I take? Please take maximum loan, and please don't be in a hurry to repay. You are never ever going to get a 8% home loan interest for 30 years, right? Nobody is going to give you a 30-year loan at as cheap as 8% interest, right?
Definitely.
So please don't repay that loan so early. There are avenues to make much higher returns over a period of time, right? So for those 90% people, please go ahead and take a loan, right? For people whose parents already have 2 homes, they are their single kid, they don't need to buy a house, please don't buy a house.
Okay.
Right? You please stay with your parents' house or rent out a house or whatever it is, right? You don't need to buy a house from your own income.
Absolutely.
Per se, right? From your own income. Of course, if they take a bigger house or whatever it is from their family wealth, it's a different case. Right? The third thing is for most people, young people who are salaried or are doing their startups. So my take is that if you want flexibility in your career, for example, you want to take some mini retirements, you want to change jobs quickly, or you want to do your own startup, please don't buy a house. it's a big drain on your financial resources, right? And that EMI is going to be a big pain for you, or a big source of worry.
Yeah.
Right?
Absolutely.
So renting is far cheaper. It works out much cheaper than buying a house, right? So if flexibility in your career is a bigger need for you, then don't buy a house. The next, I think this is applicable to most people, is that don't buy a house when you're 25, is my opinion.
Okay.
Because by 35 you will realize who your life partner is going to be, whether you are going to have kids, right? Or where your parents are, or you are now more or less settled in your career, you know what your income is, right? You know how higher you will go, whether you will become the CEO or you will become the president of a division, or you will have a normal career, or what it is. Basically the affordability at 35, 38, 40 is much better than at 25.
And maybe the life clarity is also much better.
Clarity is higher, stage is that way, right? So how big a house that you need, where do you need, where is your office, where is your spouse's office, where do you exactly want to stay, where are your kids' school, and all that clarity comes after 35. So between 35 to 40 is the best time to buy a house, because then you will also be able to afford a better house. See, my salary has probably increased how much? I think at least 10-15x. No, not more, much more than that. I think when I started in 2006, compared to that what I'm earning today, I think it is 20-30x, maybe more.
Typically happens,
So that is what will happen. So I'm 40 now. So I was 22 for my first job, 21, 22. So in these last 18-19 years, I think my salary has gone up 40x. Right? So that is what is probably going to happen with most people in India.
Absolutely.
Right? So buy a house between 35 to 40, things will be much clearer.
Absolutely.
And please buy on a home loan.
Definitely. I think looks like that if somebody has to buy a house, either it has to be the first house, so that there is no question, that is emotional attachment. So definitely use money for your emotional gains. Otherwise, think about it, maybe delay that decision so that you have more clarity, and then definitely buy it on a home loan. So if I can generalize this answer, I think we are definitely there. Great, Amey. I think towards the last, we want to ask you some of the quotes that we all keep hearing. And the typical quote that we have also heard always is that be greedy when others are fearful, and be fearful when others are greedy. Although sounds fantastic, how do I implement it?
See, realize what is going to happen. When markets fall, everybody will be fearful that the price will fall further, right? So it's not, so when we say be greedy when others are fearful, we have to act in spite of our feelings. I am not saying everybody is fearful that the markets are falling. I am also going to be fearful. Let me tell you, even after 20 years in the markets, it's not that I am not scared. I am also scared. But now I have realized that the time to buy is when I am most scared. So I have to exactly act opposite of my feelings. If you act opposite, so when I feel that अरे अभी तो stock ऊपर ही जाता रहेगा, अभी रुकते अभी और दुगना होगा, that is when I have to realize my mind, oh, I am feeling very optimistic about the entire market and my ability to make good returns in the markets. That's when I have to start, maybe 10-20% I have to sell.
Okay.
So act opposite to your feelings. Feelings you cannot change.
Absolutely.
You are going to have the same feelings that everybody is feeling.
Definitely.
Right? But you have to act opposite to your feelings.
I think this is where a professional advisor comes really handy.
It really helps.
Because I am going to be extremely passionate or emotional about the money, but as a professional advisor, you can actually be slightly at least unbiased about it.
See, there are two factors that work on the favor of the professional advisor, right? One is we have looked at multiple cycles and we have advised hundreds of people. So the problems we know, the questions we know, the degree is slightly different in everybody's case. Second, it's not my money, right? I'm advising you on your money. So don't look at it in a negative way, but I don't have the emotional problems that will be associated if it was my money.
Absolutely.
Right? So I'm able to give you advice which is appropriate to you and make you implement it. So most of the times the investor actually knows what needs to be done. The only reason he's not able to do it is he's too close to his money.
So as they say about the doctors in the same context, that if I have to operate as a doctor on my daughter, My hands might be shaky, but the doctor same can do a open heart surgery for somebody else's daughter with a professionalism. I think that is what we should learn in this. But I think if I look at investing overall, we have talked at a length about various aspects, how do they change, what should I look at while buying the stocks. But if I have to summarize as a mindset, what are the couple of high level points that do work in investing, or I as an investor must take care of them? What should be my temperament, or what are those insights that you can tell us?
So I think there is one most important quality that any investor should have, right? What we call as not having FOMO, right?
Yeah.
So see the biggest, so I'll give you an example. So Newton actually went bankrupt, right? The great physicist Newton, right? He's considered the most brilliant scientist ever to have been born, even better than Einstein, right? Now the important part to understand that he was not a nerd, not a quirky person. He was the greatest scientist of his time, but he was also what I think he was also the finance minister or something in the UK government, right?
Yeah.
So socially also he was up the ladder. He was a very rich person, and he was the greatest scientist ever to have lived. So he had a very multi-dimensional personality and successful in multiple spheres of the world, right? But what happened in the South Sea bubble? He invested in the company, made money, exited. Then what he saw was people around him, which he knew were much inferior in intellect than him, actually invested at higher levels and made far more money than him. Now he actually had that fear of missing out. So he invested at the top, and then the bubble burst, and he actually exited after he went bankrupt. Right?
Wow.
So the greatest scientist, not just the scientist, the greatest all-rounder of that time, right, actually lost money.
Just because
and became bankrupt. Just because he couldn't
resist.
He couldn't fathom the fact that inferior people, supposedly, right? He was the most intelligent guy at that time, right? So he'll feel that others are inferior to him.
Absolutely.
Inferior people are making more money than him. So you have to have your own thought, have your own conviction. Let others make money. It's okay. If others make more money than me, it's okay.
Definitely.
Till the time I have a good outcome, it's fine. Let others make more money than me, it should be fine. That is one very important
aspect.
Behavioral aspect that an investor should have.
Definitely. I think, as you rightly said, if Newton also couldn't resist, we all should at least strive to resist it, because FOMO in all the aspects of our lives has been playing out, whether it is social media or whether it is money management. I think that is very evident now that that particular aspect can actually ruin our life also.
Yes.
Now I think coming to the slightly different agenda, whenever we see investing in the last 3 to 4 years, we have seen, although the fundamentals of investing remain the same, we have seen a lot of technology play coming, because people are getting all the typical types of apps which can do transactions, which can show them so many reports, which can show them whether you call it a knowledge or data or insights onto their mobile phones. So what are your views on using technology, and how do you think technology can benefit an investor as well as somebody as an advisor? How do you use technology for?
So the most important thing to understand is, because of technology, the kind of data and access to information is available to everybody. Just 15-20 years back, the access to information itself was an issue.
Absolutely.
Right? Just to go to the annual report and figure out the profit, loss, cash flow, and over the period of time, that itself will take a lot of time, because you have to manually take it, enter in an Excel sheet. You should know how to run an Excel sheet, then compare. It used to take hours. So when I was in college, we used to actually do it manually, right? All that data is available on the, so it's a immense power. So there is no disability to the smallest investor. See, whatever access to information I have, same thing everybody else has.
Absolutely.
People who are bigger and better than me, and people who are smaller and inferior to me in investing skills. Everybody has so that is one very big advantage that technology has got, right? And it's probably a little underappreciated. So you have to have confidence that you have everything that you need to do.
Absolutely.
Need to know, right? Second problem is, because technology, information is so easily available, it's very difficult to actually isolate yourself and figure out what is really important, what is not really important.
Yeah.
Sometimes more information is
Chaotic.
just overload on your brain.
Yeah.
Okay.
Absolutely.
And if you look at technology, how it is playing a part in my business per se, then I think because of technology, the reach has substantially increased.
Okay.
Right? See, the questions and the problems and the needs of most of the investors are the same, right? So there are 50 questions that everybody has. Somebody has 25 out of them, somebody has 40 out of them. So the way we deliver our service has become that we can now reach a larger scale. So that has substantially helped us in our business.
Yeah. So whether it is democratization of information knowledge, or I think democratization of accessibility also.
Yes.
Because now I think somebody sitting even in the remotest areas of India can actually have access to someone like you also.
Correct.
And that actually is kind of empowering for all of us.
Yes.
And definitely. That I think empowerment should happen in all our money management
See,
skills.
today my clients are, so I am in Pune for the last 8 years, right?
Yeah.
Not even 10% of my clients are in Pune,
Wow.
right?
Yeah.
If this was the case 10-15 years back, I think in 2010 or 2005 this wouldn't have ever been possible.
Never been possible, absolutely. So you are now empowered, and even the clients are empowered because
Yes,
now they have the
okay.
access. Somebody sitting in US also is your client. Somebody sitting maybe in remotest areas of Delhi also can have your services, and makes sense because ultimately, as you rightly said, all of us are human beings. All of us need money, and in a way, psychologically, all of us have those 50 standard questions. Some of us might have 25, some of us might have 50. But I think the beauty about what you explained has been that how do we look at investing overall, and that is what we learned. How to avoid FOMO. How to even look at the standard problems of rent versus buy in a very personalized context. It is not a generic fits at all, and especially looking at cycles and why long-term investing is the answer to basically leave away that cyclical nature and taking our money to make it compound for a very long time. So thanks, Amey. Thanks for that. Thanks for being here and educating us as well as our audiences on to various topics. Thanks a lot.
Thanks for inviting me, Nikhil. Thank you.
Yeah.